TGIF, everyone. How's everyone doing? There's a rumor that Grega Horvat's going to be here for the opening half hour. Was that you, Ryan? I heard a little noise come out. Hi, Hugo.
I don't think Ryan's here today. Think I have to go back and look at my messages, but I think he is out today. Okay. So is Stelios as well. So
maybe we should be out.
You know what? I'm thinking about taking the day off. It's Friday. Why not? I see KMan's here. So we're just gonna just shut off our mics, throw KMan on, and let him go. I'm just kidding.
All right.
I'm joking. K-Man's like scrambling around his desk right now, looking for his microphone. And
I was running out of the room actually.
Hey, K-Man, I'm glad you're here. And I honestly, I was not trying to call you out and anything like that. But just out of memory, because I hadn't seen Ryan this morning. I'm like, you know what? I think he actually mentioned earlier this week he was going to be out. So.
Yeah,
I think this is interesting, Blake. No follow through on this breakdown under 93.5 in the Dixie.
Yeah. Unless you guys, maybe you guys didn't see it. If ForexAnalytix traders knew that 117 was a big resistance for the euro. It was the previous support back in March. So it was the March low, and it was, horizontal resistance, and there's a big breakdown point. So, and it's also a descending trend line in the euro. So I actually sold the euro yesterday. I just closed my short, actually about, 45 minutes ago or so.
Let's see the timestamp.
What's that?
I'm kidding you. Let's see the timestamp.
Oh, the NFA. You have them right here and we have a trades room in the that's the thing is if you want to go back and we put all the trades in the trades room. Yeah, there's a lot of trades.
Blake, maybe this is just ABC. Grega, I think, is still constructive. We'll know in a minute, but that maybe this little flag to resistance, we get a new low, and it takes it to where you wanted a long-term buy in euro for a long time down here. Maybe that's where we're going this month.
Yeah, I'm thinking here. I'll show you the way I'm looking at it.
Let me see some real charts.
No, I'll just give you my views, and it's easier for me to than try to explain it to you or explain have you draw it on your chart. So this, just so you guys can see, this is the 117 level.
Nice.
Again, if you are ForexAnalytix subscribers, you can go, to the basic technical analysis, the daily chart from last night. We were pushed up here. I mean, there's a lot of people that were bullish yesterday. We went out at the highs, and I'm like, yeah, you got to be real careful. There's a trend line right there. I was actually going to sell a little bit more above 119 if I could get it. I just didn't get it. I didn't get triggered. It didn't. We went to.
You're the only bear on that on the euro.
What?
For the team, the lights. You're the only red light on euro, I believe.
Oh yeah, and the indicator lights right here. We like to call them the traffic lights. Yes, we get a lot of. Well, that's the thing about using ForexAnalytix. It's like utilizing when you can get most of the indicators, if not all the indicators, in one direction. You're going to have some every once in a while, like a little, like the basic technical analysis was, it's red, and these are generated by the charts that we input. It's not like I go and I designate, it's bearish. Actually, it depends on the charts that are being uploaded. We upload charts throughout the course of
how many you think per day?
You at least one for like basic technical analysis, but we some days you get multiple updates. Like yesterday, we got 3 different updates, and a lot of the times that we're plugging in charts. But what our system does behind the scenes, you can call it an algorithm. It is, but it's not like some algorithm that's pumping out like certain income or outcomes or blah blah blah. It's more of just taking averages of what we're putting out, so based on like the time frame. So if I put out over the course of the last several weeks, I'm putting out bearish, euro dollar 4-hour charts. But then my daily charts start turning bullish, because you got an intraday bearish move, but a swing type of daily move that's green. It'll start to, it might be giving us a red basic technical analysis outcome, but then that flips over to neutral because my daily charts are starting to turn, green, if you will, or meaning we're becoming bullish on the daily chart. So, and the daily charts and the weekly charts are going to have more influence over what you're seeing on the intraday chart. So that's where all these biases really come from, and same with these arrows too.
KMan's here. A nice positive day in US dollar yen came in. Maybe
Yeah,
that was the end of it.
And actually, in KMan, if he's willing to pop on his microphone again really quick, we were just having some discussions in the chat room about the dollar yen. Hey, KMan, how are you?
Yeah, good.
Yeah, I want you to, if you can, give everybody like your thoughts on the yen, because we're looking at. I'll just show everybody what I've got on my screen here really quick. Here's the dollar yen coming up towards some resistance. It was trying to do a head and shoulder pattern, couldn't break the neckline, and you take all these other yen pairs.
It's doing what the dollar is doing now. It did it first, kind of false breakdown and then turned up.
Yeah. Well, that is happening. But look at the rest of the yen pairs. Look at the rest of the yen. Just the complex here. You got the sterling yen. The guppy up against flag resistance. Aussie yen. Triangle resistance in a very bullish trend. Kiwi yen up against flag resistance. Canadian yen's lagging just a little bit, but it's right up against flag resistance as well. So you got all these yen pairs that look very strong. Yen's weak. KMan, how are you interpreting this?
Yeah,
being that you were a yen trader for so many years.
Yeah, in the room I was saying, like, I was hoping for the end of month models to bring dollar yen lower. Yesterday was a decent short play, then covered most of it around 113.30.40. But I was hoping to bring that the end of the month would bring it down to around 112.5 to buy it, but we are not even going to get that deep. It's, in my opinion, it's not over. As I was saying before, those Japanese money managers, once they decide to unhedge, to buy unhedged bonds, they're going to be there for days. Energy remains high despite some corrections. Oil is also not really coming off fast. We have an OPEC meeting next week, but they are already saying that they are not going to change much. So energy could remain relatively high, in my opinion. And we just have to look at the price action, right? There were good cases for yen pairs to come off this week, but we're getting corrections, but we are not getting like any deep corrections which would show that the market is too short yen, long all the rest. I don't think we are there yet. So I wouldn't be surprised really if FOMC gives us what we think, and risk can continue to fare pretty well on the back of it. I can see the dollar yen or yen pairs just continue higher, really.
Yeah, and so let me ask you this: is this a product of yields racing higher? I mean, yesterday we saw some of the curve flattening, and we saw some of the lower end of the yield just ripping higher on the 2s and 5s, but this morning here goes the 10 and the 30s. They're doing the same thing. So what do you make of that?
Well, the thing of a flattening yield curve should be positive yen. In historically, when the yield curve flattens, it's making it less attractive to be short yen, and their hedging costs are supposedly coming off a little bit. But the combination of the rest of the yields rising and the market knowing well, and Kuroda telling us they are not going to change anything soon. They as I said, they already published their plans for the JGB buying until the end of 2021, and they're keeping it at the same level. They are not screwing back on their own QE. Stocks are not really coming off a lot. Energy prices are okay in ranges, but not really falling out of bed. And then you have this new government coming on over the weekend as well in Japan. They are going to continue to press the buttons for more stimulus. The combination of everything just points at a lower yen for the time being anyway. I think we are in for the 115, the big 115 test in dollar yen, but then
And that's going to be a big test.
is it
Big.
going to be dollar yen which takes everything higher? Remember a number of sessions ago, I was saying like it's not only dollar yen who is going, it's everything against yen.
Yeah.
I think
And
Blake is going.
that's where it's dangerous to counter trade all of those things. If it would only be dollar yen, dollar strength, we can probably expect some setbacks or even and deeper setbacks, even like for instance the 112, 12 and a half. But everything against yen is going. That's the thing. The rest of the, if you look at euro yields, they're going up. Italian yields are going up, but it's not only the yields; it's the real interest rates as well, which are going up, and that means higher hedging costs for Japanese. So they leave it more unhedged.
I'm gonna give you an observation really quick, KMan. We've got, and by the way, we've got Grega is going to be joining us. I think he's going to join us pretty soon. I want to make sure he gets in here pretty soon because we have Danny Blanchflower joining us today. But I want to also talk about this really quick. Gold is actually hitting lows right now, and it's funny. One of the benefits of me being on social media for the last I don't know,
100 years,
12 years, however long Dale's been on, around the same amount of time.
2000 in Eon.
Yeah, I don't know. Whenever I got on Twitter,
You were on first. Before
well,
me.
I mean, I've been on for a while, but anyway, but all of my followers are organic. I've never paid for anything or anything like that. You see, I've probably got like 70 or 80,000 tweets or something. Anyway, one of the benefits of me being on Twitter for so long is I can really gauge the retail trader. And so when I tweet something, I tweet a lot of things looking for a response. So I just tweeted gold, right? And right now I've got 1 like. Do you know what that means to me?
That means that the public's still bullish gold.
Exactly. I didn't make any comment. I just said gold. Why? Because it's breaking down. And what that means is you got traders that are watching, and by the way, I know how traders react to social media, Twitter. To just give you an example, the guys that I trade with at Gelos, minus FX Macro himself, he was the only one. Actually, no, there's 2 of them that are very active on Twitter. But the other, 5 or 6 guys in the office, they are not. And all they are observers, very large traders, and they are observers. Every once in a while, you might get a like from them, but they're watching all the key people that they want to watch on Twitter, gauging things, observing, and trading. And KMan, you probably fit that mold too. A guy that's just in the markets. You're on social media, but you're really not on social media. You are, but you're not. You know what I mean? That's the way these guys really operate. So it's funny because I can sit there and I'll put in like gold, and it's obviously breaking down. And when I get no one responding, that means that the market's long. Because if I knew everybody was like bearish gold right now, I would have got retweets, high fives, likes, and oh yeah, dump it. I would have got those types of responses. When it's crickets, that means that the market's long. So what is, and I guess going back to the yen, again, KMan, you've been trading the yen for so long. What do you use that correlation between yen and gold?
I don't.
That was a big question yesterday.
I'm sorry.
I don't. I
Okay.
think it's a case of it used to be used in the past, and charts have been shown, but then you see different correlations at different times. I'm not really using the gold yen correlation a lot, to be honest.
Okay.
No.
Yeah. Okay. Yeah. No, and I thought I'd ask you just because. I mean, usually when gold is weakening, yen is weakening as well. So I mean, I was just wondering if that's maybe a confirmation.
We've had too many exceptions to that since the pandemic, in my opinion.
Okay,
too many days where they both move same way, or when something is moved. But look, we have a good example. Dollar yen moved from 110 to 114. What did gold do? Range.
Yeah, true. Good point. All right, and you know, usually for me, it's more intraday. Like you know, like I pay attention more intraday. Like I use it for like let's think the game dominoes. I use it like a domino effect intraday. So, you know, if the yen starts breaking down, but like, you know, you see the dollar yen popping up above like 113, you know, 80s or 70s or whatever, then I look over at gold and I'm like, oh, gold hasn't moved. I'm going to short that really quick and see if I can make a couple quick bucks. You know what I mean? More of a, not like, oh, you know, dollar yen's breaking out, so I'm going to short gold and stay in it for the next month. I try not to do that because I agree with you. The relationships on more of on a day-to-day or week-to-week basis tend to be a lot, you know, less, but intraday every once in a while, it's like kicking over a domino, you know, like one knocking the other one over. Anyway, hey, KMan, I want to say thank you for your opinions and your inputs, because I think they're extremely valuable for the ForexAnalytix community. But I don't want to take any more time away from Grega, because Grega is here, and he wanted to give us a quick Elliott wave view of the market before Danny Blanchflower comes in, which I know we're all waiting to hear from. So, Grega, good morning.
Hey, good morning. How are you?
I'm good. TGIF. I'm going to pass it over to you and Dale, so you guys, you can show some of your charts. Glad you could be here today. So here you go.
Yeah, thanks.
Hi, Grega. How are you, buddy?
Hey, Dale. I'm fine. Like
Good.
always, you know.
So I know when you want to come on, you have, okay, interesting. Because I know last time we talked, it must have been a weekly chart, a long-term chart, that you had a 5 coming in the Dow. So now it's starting to show up in the S&P.
Yeah, I mean, recently we've been talking about this dollar index that I'm seeing it as at a resistance and potential support for euro dollar. I've been highlighting that if euro is really going to see a bounce, which after all has been one of the weakest, then I think that other very strong currencies, commodity currencies, should, in my opinion, do even better, especially now when we still have this risk on flows here that could extend even higher on US markets into the all-time highs. So first thing, I want to look at the S&P 500. We definitely completed this counter trend movement here, and notice that we have some very nice higher highs, higher swing lows here for the last few weeks for the whole October. So looks like that we are making a new impulsive rise here. Of course, any dips, I think that there can be opportunities on the long side. And as long as that's the case, I will remain bullish on commodity currencies. And within this context, I really like Kiwi. I've been talking about this one quite a lot.
And recently it's been underperforming Aussie, hasn't it?
Yeah. I mean, it's not really anything big here. We are just, you know, consolidating. Even Aussie did not make any significant moves to the upside. I think that in this type of tight ranges, you will typically see that some will perform the others. But overall, both have still quite clear direction, in my opinion. When I'm looking at this 4-hour chart, I still see incomplete and ongoing impulse away from that September lows. And as you know, we've been discussing about that last time. And I've been highlighting that even if I have this bearish interpretation with 5 waves down for a leading diagonal here, okay, for a wave A, and now you're in a counter-trend movement because you can be in a free wave rally here, even a wave C is a motive wave for those who are not familiar with the Elliott wave principle. So I have bearish interpretation, which suggests more upside in the near term. Yeah. And here I have this very strong bullish interpretation, which actually shows that this very choppy overlapping drop from that February highs is actually counter-trend movement that is now taking almost 8 months or so. So in my opinion, this fits even better to a potential bullish call, but it's very good to be careful and always just observe potential minimum expectations and try to build a trade plan based on this. And if moves maybe will extend, then reward can be even bigger. So in my opinion, I still think that this is a counter-trend movement, very nice support. The first one was at 71.34. Deeper one, maybe ideal for a wave 4 would be at 70.90, because that's also the 38.2% here, as well as the previous swing high when we got this massive drop here. So I think that still this looks very corrective because we are slow here, not really impulsive from the highs. So yes, I will definitely still.
So S&P and Kiwi should complete together.
Yeah, that would be ideal. Yes.
And did you let me ask you, Grega, on where 5? I know we have a 4 coming. Maybe we're beginning it from yesterday. What is the range for 5 on the S&Ps to complete? I know you can't have an exact number. You have a range up there, 46.5 to 47.
Look, here I have this intraday wave count for the S&P as well, okay?
Okay.
And let me label this. Okay. And now you are still in the middle of this wave 3 that I'm expecting to continue even higher. And looks like that this current price action from the last few days is just a consolidation. I just don't see a reason why I would try to pick a top here when we have very strong uptrend. So if we get a dip here, then of course, just watch the previous consolidation for a potential price stabilization. That would be at 45.20 up to 45.40. So that would be ideal zone for potential support for this wave 4, unless we are going to see a triangle here. Let's assume that Friday will be slow, which maybe would not be a surprise. And then we
just come out of here.
Yes, exactly. So in my opinion, I see both in a corrective 4th wave retracement, and I'm just will continue.
Hey Greg, I'm sorry. I just wanted to say something really quick. I have been actually updating a couple of charts, so I kind of listening to you in the background, but I saw you talking about the S&P here. So let me ask you this: I know you're obviously you look at a lot of Elliott waves, but that's not the only thing you're looking at. Because I have now known you as a team member for the last 5 years, I've gotten to know you pretty well. Let me ask you this though: as regarding the markets and your comments about Friday being kind of slow, we did have some pretty bad earnings overnight. Do you think that's gonna, that might kickstart the market a little bit? I mean, with some of the big earnings that or do you think that might weigh on the market a little bit?
Yeah, I mean, last time I posted that chart when we have big companies, some trading quite significantly to the downside, while the S&P 500 was trading much higher. So there's definitely a big gap between the index and some very major single stocks because of earnings. So this could definitely impact the price action in the near future. But even if we see some kind of a slowdown here, I just think that the main direction of the index should be considered where maybe others could be headed. You have some very big names that are trading much lower because of earnings, but maybe there is just opportunity to buy them cheaper.
Yeah, that's true. Hey, and by the way, thanks for your thoughts. And I want to say that great call on the Aussie, back when it was like around 74 cents on 74 and 50 or somewhere around there where you were long and you were very bullish. And I wasn't a buyer then. And I was like, yeah, Greg is bullish, but I can't do it. And, it was a great call, ended up screaming higher. So great job on that a couple weeks back.
Yeah, thank you.
All right.
Okay, we have you have interview, Dale?
We have 5 minutes, Grega.
Okay,
if you want to cover some more things.
Okay, so yes, let's take a look also maybe on let's take a look on dollar Mexican peso, because I'm sure that Blake has something to add.
Oh yeah, baby.
Yeah.
I'm actually long Euro Max. I'm long dollar Max too, but I bought a lot of Euro Max earlier this week. So that's the trade that I wanted to be in, because it's really the one that's I've been wanting to be in more so than the dollar Max, but I am long both. So yes, go ahead.
Yeah, I mean, before I will go to dollar Max, let me share this chart. Okay, I think it should be here. Okay, so actually being long dollar Max is maybe the right thing whenever we consider the correlation between others, okay, compared to others. I mean, here I have this dollar Mexican peso is in blue, while you have all the other currencies being much, much stronger versus the US dollar. So I have inverted major pairs, as you can see here. So being long dollar Mexican peso, I mean, or being short Mexican peso is maybe the right thing to do, is if you want to be positioned on the direction of a stronger US dollar. Because obviously it's Mexican peso, it's one of the weakest here. But what is my game plan here is, because I'm still expecting that overall commodity currency strength will resume. I think that crude oil is still somehow in a correction, and that sooner or later we will again see a recovery. I think that dollar Mexican peso, for me, that's my game plan, not for Blake. For me, I think that it's at quite interesting levels if this overall commodity trend will really resume. So what I'm looking at here at the dollar Mexican peso is, let me share this again, is actually still a triangle. I've been tracking this triangle for the last 6 months or so. And looks like that we are still in the middle of this trend. But what I really like, based on the latest price action, is that we stopped at the 61.8% and we came down from that swing high with 5 waves. And I've been calling this corrective rally, and so far is quite strong, but it's definitely at very interesting levels, as I said. So I will be watching this one very closely next week, not now because it's Friday, but next week, if we can still chopping around here, or maybe even see some kind of a weakness back towards 20.30, then I think that I would be willing even to look for potential opportunities on the short side.
Thanks for your thoughts, Grega, regarding that.
Welcome. Yeah, thanks for being here, Grega.
Yeah, and by the way, guys, we do have before you bring on Danny Blanchflower, we do have PCE data coming out and Canadian GDP. And Grega, do you mind if I take over the charts really quick just to give everybody a view of that?
Yeah, I just
Yeah, thank you so much for being here. I just again, this is, if we weren't so focused on inflation right now, if the market wasn't so focused on inflation, I wouldn't even bother. But today we do have this PCE data coming out, and I think it's important that we.
Always good to have you, Wizard.
Yes, thank you so much, Grega, for being here and your thoughts. And now I'm gonna have to carefully watch my dollar Mexican peso. I thought I was having a home run here, and now I've got to be a little bit more cautious. Thanks, Grega. Being a little sarcastic, but seriously, he brings up a great point, especially if commodities are going to continue to rally from current levels. The dollar Mexican peso might not actually be a bad, or the peso might not actually be a bad long here if you want to play into that market. So here's some the PCEs coming up. We also have Canadian GDP coming out, and following the I mean, look, and I'm sure I'm sure Danny Blanchfire has something to say about what central banks are doing right now, and especially with, here's the Bank of Canada, really making a move to tighten monetary policy. Let's see if GDP data comes out here shortly. Oh, there you go. Canadian GDP is a miss. Personal income down. Wow. PCE came in line. Consumption a little stronger than expected. We are seeing the dollar Canadian a little weaker. The euro, or the US dollar, not a whole lot of movement. We had a little bit of dollar strength. Now it's kind of weakening a little bit. Just really not a big mover as of right now. PCE came in line. So personal income, I would assume you expect it to drop a little bit here anyway, but that's a pretty big drop. So we'll see how the market takes all this in on a Friday. Looks like the market's not being influenced a whole lot, but again, I'm assuming right now, considering the rates market, Dale, and what's happening with how the market's actually starting to see all central banks, especially the Bank of England, starting to price in a lot of rate hikes moving forward.
Yeah, I think they have
I'm
four.
Sure it's going to be some great conversations you're going to have with Danny Blanchfire. So I'm going to let you take over.
Always is.
Thanks everybody for being part of the F.A.C.E webinar and being part of the ForexAnalytix experience, community experience. We appreciate having you all here, and I'm going to pass it over to you, Dale. Thanks. TGIF.
Thanks, Blake. Have a great weekend, buddy.
You do the same thing. Thank you.
All right, Danny, welcome back. I want to thank you for reaching out to tell me about this new report you have.
Yeah, can you hear me now? Hopefully you can.
Yeah. Were you going to show anything in the report?
Yeah, I have a chart I'd like to show.
Okay, so you just punched the green button, share screen?
Yeah, I want to show a chart. I think it's a scary chart. It's coming. Here we are.
All right.
Okay. So here's this. Can I talk about the chart?
Yeah. Okay? Yes, go ahead. Start off.
Obviously, the story that I have been worried about, and it's really about central banks, and it's about what central banks are up to and what they've done in the last dozen years. My view approximately is that every action of tightening in the last 12 years has been an error. So the Fed and the Bank of England missed the Great Recession. They wrongly tightened from 2015 to 18, and most of it was because they didn't really understand kind of what was coming. So the story is that, we date recessions from the NBR dating group 6 to a dozen months after the recession's been caused. But the work that I've been doing with my pal Alex Bryson, we've written 3 papers in the last month or so because we got on a roll. And the answer is that consumer confidence is a really big deal. And it adds pretty well to your conversation a minute ago. And the answer is that consumer confidence, consumer expectations, fear of unemployment turns out to predict perfectly well 6 of the last 6 recessions, Dale. So if you look at these papers, I show you that if you take each of the recessions that the NBR calls, these data give you a call for it between 6 and 12 months ahead of time. So if you look back to December 2007 is what the Fed, what the NBR called the data recession. These data told you by around May of 07 that it was coming. So this is a scary chart. So this chart, can you see it? The one with the yellow and the purple.
Right.
So this is the Conference Board consumer expectations data for the 8 biggest states. And the yellows are the peaks in the prior 12 months, which is the rule we use. Look back at the peak in the prior 12 months. What happens to that index over that 12-month period? So December 07 is the start of the recession. So let's just go to Florida. Florida peaks in February 07, falls by 60 points by December 07. California falls by 35. New York falls by 25. Ohio falls by 23, and Pennsylvania by 40. So the question then is, well, what the heck's coming? And in the context of the Bank of England talking about tightening, Canada talking about tightening, the Fed talking about tapering, this looks like an unbelievable error. So here's the data for now. So it turns out it looks almost identical to what happened in 07. So look at California. It was peaked at 127.5 in March. It's now at 93. 121.3 in Florida. It's now at 94.
It's 92.8 now, Danny.
The 8 of them. These are the 8 biggest states. These suggest to you that the US is going to enter recession at the start of next year. That should put the discussion about tightening in big context.
Okay. Yeah, you know, I was going to ask you, you answered a lot of the questions that I was going to ask you. Yes, I'm here, Danny. Can you hear me?
Yeah, if you want me to keep going, I will. I just want to make sure that you can see that and we can talk about this.
Yeah.
And so the final thing is that basically there's, and we can talk about what other evidence of tightening there is. We just got a Gallup Consumer Sentiment Index out yesterday. That was minus 33 in April 20. It reached a peak of 1 in June 21, and yesterday it went to minus 25. So these consumer sentiment indices, A, have collapsed, but B, they're predictive.
Okay. All right. So
I'm sorry, hey, Dale, do you mind? Hi, Danny. I'm Blake Morrow.
Hi, Blake.
Hi, how are you?
I'm good.
Hey, thanks for joining us today. And Dale, I'm so sorry to interject. I don't think you saw my Skype message. I actually wanted to see if I could ask Danny a question about the Fed. Based on the data that you're seeing, do you think that the Fed might be making a policy error? You know,
definitely.
That's what he was getting at.
That's exactly the point. And I could talk more about this, and we should. But supposing this was true, right? I mean, you can't rule out the possibility that this time it's because everything is so weird that this time it's wrong, but nothing else, zero else predicts the prior 6. So the data is what the data is, and I've got lots more of it, but this is a simple way of showing it. So if these data are right, then the Fed tightening will be a huge error. The Bank of England, in fact, you can show the Bank of England would be a huge error too. And I called.
Yeah, they're talking for interest rate hikes. We're only talking about tapering.
I'm also talking
they're more aggressive.
About tightening, about tapering, because tapering amounts to tightening monetary policy in the face of a slowing economy.
Well, you know, let me push back, Danny. Do you think the Fed has to keep buying MBSs with a housing shortage and record prices and people being shut out of it?
Yeah, right.
Does the housing market really need that support, Danny?
Well, maybe it just switches to buying treasury.
Well, then why haven't they? Why they're creating?
My point would be,
why aren't they?
My point more would be, wait and watch. Wait in a few months to see what happens isn't going to make that much difference. But I agree with you. The idea.
Sheila Bear said the same thing. She's afraid. Are you friends with Sheila?
So let me just go with a few other things.
Okay.
So what have we seen since these data started to turn? Well, we obviously got slowing GDP yesterday. I think that's potentially likely, but we have a whole series of surveys asking people about COVID. And I think COVID and Delta is particularly what's driven this. There's evidence that people are scared to go back to work. A survey in Britain this week, 40% of people said, I'm going to quit my job if I have to go back to work and work with someone who's unvaccinated. So
that's a great resignation, Danny, right?
Yeah, even resignation. Right.
Yeah.
And there's a Grant Thornton survey and a conference board survey where they ask people, you know, are you fearful of going back to work where there's not, where you're forced to go back to work? And I think some of it's that looks to be consistent with what's going on in the data. And so then a lot of it's amongst women. And what we've just seen is women saying, I'm fearful of going back to the office. And this is exactly what happened to my daughter. My daughter had a job where she was told on Monday she has to go back to the office. She's got 3 young kids. She's got to go back to the office. She'd been working remotely. She quit within the hour. Got another job where she didn't have to go back remotely. So I think the issue here is very crazy data in the labor market. I mean, I'm a labor economist. When the unemployment rate rises, wage growth doesn't normally rise, which is what we've seen. So I think these data are really, they're flashing red. They were flashing amber. Now they're flashing red. And I take your point that you want to be careful about what you do. But my view would be, you better, at the best, my action would be, you better sit and wait and watch.
Yeah, you were for the bazookas firing off and felt comfortable that, you know, Yellen and Bernanke had it under control, that they went big and they were going to continue to go big. But some of these inflation numbers. I know you said with inflation, well, like when lumber was going up, Danny, you said, well, they could find a replacement material. But, how do you find replacement food items?
Well, the answer is if the price of meat goes up, you buy fish. That's what happens. I mean, the classic story. I mean, so I think the listeners have to get what a central banker does. So I made 36 decisions in a row. And each month you think, well, look at the decision I made last month and the things that I thought about. Was I wrong then? And what's changed since? But the big deal I always had in my head, which is what impacts are there on inflation 18 months ahead? Now, just because something goes up by 5% today, right? Something goes up by 5%. Well, it may well remain at that price in a year's time, but if it just remains there, inflation is zero. And the question is, well, okay, if a price rises now, what's the argument for it to continue? Because if it rises 3% in a year's time, if it just remains flat, inflation's zero. So the question is, what causes it to rise again next year? But I think listeners don't kind of get this quite. The inflation measure is a measure of the price of a representative basket of goods. But if the price of a particular good rises, then you don't buy it and you buy something else that's cheaper, which means that in principle, the basket of goods that you're referring to changes. Most of the things in this basket of goods, you can avoid buying. You either don't buy them at all, or you buy a substitute. And even when the price of gas goes up, you can respond to it by driving less, by buying smaller cars and so on.
Yeah.
So
heat your home less. And
no, you're right on the context of, obviously it's harder the more.
How about wages, Danny? I mean, wages. Okay, we're giving you a raise, but we want to take inflation down a notch. I'm giving you a pay cut.
Remember, Dale. But I have a little story which people, a nice way of saying it. Think about, let's just make a little story. Each month inflation comes in at 0.1. So we're merrily modeling along. Inflation is 1.2. Each month we drop a 0.1 and we gain a 0.1. And then the next
Someone said ride your bike, Dan.
Okay, let's just get this. We get 0.1s and then in month January, we get 4% in that single month. So now in each month, then after that, we get 0.1. So what happens is for the next year, inflation is 5.1. Each month is 5.1. But then in a year's time, that 4 drops out and the central bank and me knows it's going to drop out. And you say, oh, look, inflation's 5. It's terrible. It's 5. And I say nothing to see here because there's a 4. And the 4 is what's lifted this thing up. And the big question we should debate is, okay, things have lifted now. Tell me why in a year's time they're going to lift again. Just because they've risen this year, that's fine. But that's inflation 0 next year. Prices next year could be higher, but inflation could still be 0. So the answer is, what is there in there, which is Christine Lagarde's point, Jay Powell's, why would inflation rise again? And I see nothing to suggest it will.
Well, because if we don't have your recession,
Dale.
if we don't, no, let me ask this question. If we don't have this recession, prices like metals, where it takes 8 years to bring on a new mine to generate production, and copper is going to be a big part of the environmentally friendly green economy, that the supplies are, this squeeze on supplies may not be alleviated next year or the year after.
That may
Only
be right.
A recession would cure that price problem.
Dale, the issue is not so much the price of commodities, let's say, go from 100 to 200, and you say to me, wow, the price is really high. But if next year the price is 200 and it's still 200, that's fine. Prices are really high, but inflation's 0. Inflation is 0. That's the first thing. And the second thing is, you said much the same about timber prices, right? So timber prices rose like crazy. So what happens? Well, people stop using timber. I mean, that's what happens. So we've seen moves up in commodity prices, but people started building patios outside their restaurants because of COVID. People were building. I've got
we adjust. It's amazing how we adjust.
We adjust that, and I think that the issue has to be. I just don't think people understand that. For you to argue that inflation rises, it's not about our prices higher. It's about, yeah, there's a price increase from 100 to 200. That means the price of commodities is much higher than it's been forever. But if it stays at 200 for the next year and the year after that, inflation is zero. That's it. So I don't buy the argument. You know, I mean, people stop buying wood when the price. I mean, I had to buy some new windows, and the price of aluminum windows rose dramatically with the tariffs. Well, then people started selling vinyl windows. You look for substitutes that are cheaper. So that's what people will do. But I just, you know,
well, it makes me want to go out and buy a million shares of Beyond Meat.
Dale.
Go ahead, Steve.
Go
ahead.
Hello, Mr.
Buy some
Bluntflower.
Beyond Meat, artificial food, Danny.
Well, but you take the point. So let's have a discussion where we start to say, what for a central banker like me who sees these scary things, this is really scary. This forecast 6 of the last 6 recessions, I see inflation being temporary, and I say to myself, tell me anything that suggests to me in 12 months' time this is all going to sort of go again. And the analogy, Dale, is I think of this as a hurricane hits an island, right? So the hurricane hits, well, the water and electricity gets wiped out. The price of food rises. The price of carpenters and roofers and all that goes from $50 to $2,000 an hour. Okay, and in 6 months, we've adjusted to the shock. What's the effect of that huge shock in 12 months' time? Answer, nothing. Zero. The temporary rise in everything, the price of food rises, the price of leaf blowers rises, and in 6 months, it's over. And the wage of the roofers goes back to normal in 12 months' time. So the question is, why does everybody think that this thing is going to be permanent, where everything we see suggests that it isn't? So tell me something that suggests to me that this rise that you've talked about is going to be repeated next year. And I see nothing to tell me that.
Go ahead, Steve.
Dr. Blanchflower, sorry to interject. It's Steve
of course.
Here. Okay. Can I reverse some of the arguments and get your academic?
Well, not just an academic. I was a central banker, remember? So
I know. But also your academic point of view. So yeah, yes, you do combine both worlds. Okay. So let me ask you something else. If we extend these arguments, is there ever a signal that would make central banks go off zero anymore?
Well, it's a great question. So remember that every one of these arguments over the last decade has been wrong. So you're right. The question is there something permanently that's going to change that will permanently give us a higher rate of inflation? So the answer over the last 12 years, and I have been in many, many discussions on radio and TV about exactly this, of the inflationists telling me inflation was coming, and I kept saying it isn't. I think it's hard to see. It's hard to see many of those things happening unless the economy is anywhere close to full employment. And I think, and the book, my Not Working book, talks a lot about that, and basically says that the mistake that people have made is to think the economy actually is running hot when it isn't. The labor market is running hot when it isn't. And I think in all probability, full employment is probably somewhere where the unemployment rate is under 2. So unless the labor market really cranks and the workers' bargaining power is to rise a lot, the scale of the slack in the economy means that none of those arguments is going to take
Yes,
off.
I agree with you. The labor market is never say never, but in the foreseeable future, it's never going to be hot, simply because
I think that's right.
Simply because economic policies, for example, like the minimum wage, will keep preventing the labor market from running hot. Plus,
it's hard to argue. It's hard to argue that, given that this week we just had a friend of mine who won the Nobel Prize for saying something the opposite of that about the minimum wage. So pretty hard discussion to make in this week when he showed that minimum wages rises don't really affect employment, and as you raise the minimum wage, productivity rises. But besides that, I mean, literally this week, that's what he won the Nobel Prize for. So I think I'm allowed to counter that.
Yeah, I think that carries some weight.
Yeah, okay. Although, I'm an economist.
That was a pretty good riposte there, wasn't it?
It was, but I'm an economist myself, and I fail to see the price of any product going higher and the demand for that product not decreasing. I haven't seen a product that works like that.
Well, the answer is the minimum. So go and read the minimum wage books. Just go back to what they did. What they did is pretty interesting. So my friends Alan Kruger, who sadly passed 2 years ago, they were sitting at Princeton University and saw that the state of New Jersey was going to raise the minimum wage. So they decided they'd look and see what it did. So they went to look at fast food houses on the borders of Pennsylvania and New Jersey, right? So New Jersey fast food houses are going to get a rise in the minimum wage. Pennsylvania isn't, and they tracked what happened. And what they found was that employment didn't change. And they found that one of the big things that happened was that productivity rose because as you paid more, people stayed longer, and that raised productivity. So you could say you can't believe it, but they won a Nobel Prize for it.
The fast food argument is a very interesting one because I can counter to that. The previous time I was in New York, not the last time I went, the one before that, and I went to a fast food restaurant. It was full of employees, and the last time I was in New York, which was 2 years ago, everything but the delivery of food was done by machines in Wendy's. So you had to order in a machine.
There are weirdnesses going on in the labor market right now, but you can argue on a basis of an anecdote. But they did win a Nobel Prize for it. Come on.
Okay.
Come on.
I can name a lot of people, but okay.
I mean,
yeah. It's a big discussion.
Anyhow, going back. So if you go back to, let's think about what full employment is. And the Fed basically believed that in 2015 to 18, that the labor market was close to full employment because unemployment rates were about 3.5%. And they expected that wage growth would be, flying. Well, wage growth never flew. And the reason was that that 3.5 was far above what the full unemployment rate was. And I just want to throw something in there. If you go back and look at Beveridge, so Beveridge wrote this great report. Churchill said to Beveridge, when the war's over, all these troops are coming back from the war and women have worked in factories, they're going to come back to work. What does full employment look like? So he wrote a thing which said, I think 3% unemployment is the full employment rate of is full employment. And he writes 10 years later and he says, well, Keynes wrote to me and said, I think 3% is too low, but let's see what you can do. So in the UK, then he writes 10 years later, in the UK between 1950 and 1960, the unemployment rate averaged 1.5%. Why shouldn't you get to that again? And unless you do, and unless bargaining power of workers rises, then we're not going to see any of this inflation takeoff. So central bankers, the answer by default is inflation by default is going to be 1.5, and your problem probably 18 months ahead is inflation is going to be too low again.
So how far down the line, Danny, does Powell reverse course on the table?
Well, I think it's a really good question, Dale. I think, so my view, my policy prescription would be, boy, this looks bad, but let's hang on and wait a bit. Let's not taper for a bit. Let's not do anything. Bank of England shouldn't do anything.
Well, maybe he'll do that Tuesday. Do you think there's a chance he'll do that?
I think so let's talk about the Bank of England. So the new guy, Pill, came and gave this speech, which is pretty interesting, and Bailey did too, saying basically rate rises are coming. Well, it's pretty interesting. It's quite clear that they haven't, I can guarantee you there's no chance, at least a majority of the people on the committee. So what we've seen since then is the data have weakened, consumer confidence has weakened, obviously the stuff in the US, and we've started to hear from other members of the committee. So Tenreiro gave a speech this week saying, I ain't raise it. And I think what's interesting, Dale, is that there has never been an example, apart from a couple of times at the end of a tightening cycle, where the bank has gone from a 9-0 vote against to a vote in favor of a change. So that should tell you historically, the market looks to be out. I mean, it was like 100% likely they're going to make a rate rise. And now it's at about, when I looked yesterday, about 60% likely. I think it would be a huge error, and I think the likelihood of it, well, they may do so. It would be a huge mistake. I mean, they're still doing QE there. They're still the QE hasn't even finished yet. So the idea that you're going to, with Brexit, I mean, they had a forecast come out yesterday which said that the government forecasting body said their estimate is that Brexit will lower GDP by 4% in the long run. Well, okay. So you got Brexit, you got raging COVID, rising story in the New York Times this morning that unlike everywhere else, COVID.
Yeah, I believe there's a new variant in the UK.
Yeah, apparently there's a new variant there. 6% of cases have got that. So you're going to say we're going to tighten monetary policy in the same week, Dale, where the fiscal authorities cut unemployment benefits, they raised the social security taxes on jobs, and they cut spending on various things. And you're telling me that the central bank is going to raise rates? I mean, come on, guys. This is,
you're not the only economist that's worried about them pushing in the direction that the economy is going in, which is, basically weakening after all the free money is gone now.
Well, we listened to Christine Lagarde yesterday, and I do think, Dale, that people have underestimated that people are responding to COVID. So let's go with here's the possibility we should think about. So, okay, people made all these savings, and the expectation is that people are gonna go out and spend them. Well, maybe what's happened is that they've given people a buffer. So this data looks to be a bit like this. Women are fearful of going back to work. They're fearful of going to places that don't have masks. So what's happened is that we've seen an increase in people retiring, particularly amongst women. But the big story we saw last month, and again, this may be a tick, but it may be a trend. Last month, 25 to 54-year-old women's the female participation rate of these prime age women dropped by 0.7 on the month. It went from 74. It went from like 74.7 to 74. This data are noisy, so maybe if it picks back up next month, fine. But imagine we get another month of a drop of 0.7. And I think this may well be temporary. The buffer is you've got enough buffer, you've got enough savings, so you can sit and watch what COVID does, and take 6 months to protect your family, and then you'll come back when things are more like normal. So I think people should be fearful of COVID, and in the UK with raging COVID much more than any place else, and a new variant, and basically driving it, particularly amongst children at school, people are fearful. And I think hard to argue that my data that we looked at earlier is not predictive. Maybe it's not. But I don't think people should ignore these data. You should say,
no, Danny, I went into Walgreens.
What?
I went into Walgreens to get a flu shot yesterday. And I didn't have an appointment, and there was a huge line around the store for people lining up for boosters. So, if people were calm about this, they wouldn't be the week of that you could go get boosters. It was almost everyone.
I think that's right, Dale. Yeah. So it's this sort of sensible Danny Blanchard.
I still worry about it.
Yes. I mean, my story that when I got mine, I've had my third shot, and I was in Florida, and it was December the 28th, and they said, we've got some good stuff. Do you want to go and line up? So I got there at 4:30 in the morning, and I lined up for 8 hours. Oh, seriously. And I got a shot in December. So then I had my third booster because it was 9 months after the first one. But there were a lot of people there. I mean, there was 1,000 people basically standing in line at 4 o'clock in the morning. That was how you had to be 65.
So the whole world has PTSD from COVID.
Well, but Dale, there's another thing. There's another thing too, and we're starting to see evidence of long COVID. And David Kotok particularly has been worried about it. But think about we have the estimates are between 5 and 10 million people in the US have long COVID, either because they got PTSD, or because they were on a ventilator, or they had organ failure or something. And that's going to impact the labor market. It's going to impact whether people show up to work. It's going to impact whether they're able to work. And so this is going to have long and lingering effects, which doesn't.
How long before we go to universal income here in the US?
Long before that. But I think the answer is that, but the answer, Dale, is that, this is a deep shock. An economy is still adjusting. And the last thing we should do is be kicking people while they're down. So the idea of tapering, raising rates anytime soon with this collapse in consumer confidence seems to me a big error.
Yeah, it's 1930 all over. Isn't that what the Fed did after in the 30s? They started tightening again when it looked like we were coming out of it. Same thing.
That's exactly what so you got monetary policy wrong allowed collapse of banks, which causes the great crash. You're on the gold standard. You're doing much too tight monetary policy. The answer is through all of this. What's the scale of the shock, Dale? This is a negative shock. I mean, so just go yesterday. The government yesterday, try this one. The government yesterday in the UK, in its forecast that GDP growth in 2022 with a raging COVID was going to be 6%. What do you think the chances of that are? None.
6%.
6% growth. 6%.
There's a 6% chance that
6% GDP growth
in
2022. Good luck with that.
Yeah. All right. Well, look, I'm going to go out and buy some bonds.
Here you go.
And I'm going to go buy some freeze-dried food, and I work from home, so
Me too.
I could stay COVID free.
I'll get your booster shot.
I will do that, and I will set up a time for us to talk about this again, because I think that some of the things you're talking about we're going to see definitely either into or after the holidays. It's going to be interesting.
Well, the right thing there is to wait and watch what this stuff is doing. Let's see if the labor market participation rates will go in the other direction. But as I said, yesterday's Gallup sentiment data scared me senseless. It was minus 33 in April 20. It goes up to 1 in June. Now it's minus 25. You're going to ignore that? You're going to ignore the fact that people are afraid?
No, I'm going to look for a place to short this market early next year for a 30% decline.
I think that's the right thing to do.
That's what I'm going to look to do.
Well, just
and then Steve can ask you questions, and it was really fun. It's always fun having you here, Danny, and I think people should follow you and listen, and it's fine.
The paper that I've been doing is on my website. You can go to my Twitter feed. I've got it there, but if you need to, you can go to my website, and these papers are all downloadable. You can get them and look at them. And the question is, I could be wrong, but maybe I'm not.
Sure.
Maybe I'm not. And if I'm not, then you're in trouble, because I've been right the last 6 times in a row. That's it. That's okay.
Well, you're due to be wrong, but I with what I see, I don't think so. So looks like you revamped it a little bit.
Yeah. So there's the economics of walking about and predicting risk. Go back up. That's the paper that people should look to. The economics of walking about and predicting U.S. downturns. There's a little note for the UK about why the Bank of England shouldn't raise rates. That's the recession is the threat. So that just says they're out of their tiny minds if they're going to raise rates. And then there's others. If you go down a bit, there's a couple of others too, which is about Europe. So we have data predicting. So if you go down a bit more, keep going. Yeah. So there's another. Go back up. See my fishing pictures.
We know what Danny likes to do. Danny's crossing his fingers and hoping.
Yeah, that's crossing fingers and hoping economics. Yeah. I think that's where
hope is, Danny, hope is the oxygen in our lives and the carbon dioxide.
Well, hope is the oxygen, but fear is important, right? So if you go up a little bit, there's a couple of other papers up there too. Go up a bit, please. Okay. Yeah. So so anyway, those are the real ones. I'm sorry, you've gone past it again. There's a couple of others there about Europe. I mean, the other thing. So it's down a bit more. Yeah, there's more there. So the economics of walking about and predicting unemployment is another one. I mean, Dale, there's another set of things there where in Europe we have these data which ask people, what do you think is going to happen to unemployment? We call it the fear of unemployment. And you say hope is right, but also people know, right? People know that unemployment is going to rise. If you ask people, do you think the unemployment rate is going to rise? Turns out they're much better than the markets. They're much better than macroeconomists. And we talk about the fact that people actually know. So hope's important, but also lack of hope is pretty important, Dale. And remember through this, if people think there's going to be a collapse in the stock market, or if people think there's going to be a recession, there's going to be a recession. It doesn't matter what the macro forecasters say. It doesn't matter what the markets say. It doesn't matter.
It's all psychology. Confidence. So isn't it confidence, and you lose that when people understand the con in the confidence?
Well, that's true. They also understand the con in econometrics too, right? Which is what many of us do. But
Danny, I could go on with you for forever.
But we got to stop. Well, let's do it again. When we'll look at some data coming. I mean, the question is, does some data come that suggests that I'm wrong, or does some data come suggesting I'm right? We'll see. Yeah.
I hope you're wrong.
I do too.
I know you do. All right, Danny. So if I don't talk to you before, have a happy Thanksgiving.
You too.
Up.
You
And,
too. And I've got another 2 grandchildren since I last spoke. I've now got 9.
Yeah. Oh, oh my God. All those genes they're all over the place. Your genes.
They're all over the place. And the first one was born. I put a load of money into a stock fund. I said, "Oh, that'll be fine." I thought I was going to get 1 or 2, and now I'm up to. It's cost me more money. Children are costing me more money than I expected.
You're a happy man despite what you have to write.
Exactly.
You have to say what you see and
go fishing.
Yeah. All right, buddy.
Bye, buddy.
I hope you good fishing, good hunting, and
yes, sir.
Let's keep in touch and do it again, cool. Danny.
Rock and roll. Bye, guys.
Adios. So everyone, that's a wrap. I know we ran a little over, and you could join the team in 10 minutes for the Morning Edge. I want to thank everybody for being with us this week, and we hope we added value to what you're trying to accomplish. It's not an easy thing to do. It's easier to talk about it than do it. And I hope that, what we do here every day, teaches you things that like Danny's a fisherman. So we're trying to teach you how to fish. So have a great weekend, everyone. Remember, don't just count your pips, count your blessings. Adios. Enjoy your weekend and see you next week. Adios. Thank you, Monica, Dave. See you guys. Jatin.